Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. They say all charts will tell you some kind of a story. Currently, 10-year US yield chart is telling us a story that from a current level of 4.38, it can move towards 4.55 and 4.70 kind of levels. This chart is indicating two aspects. First, the dollar index can move higher and risk off mode in the financial market can start. Now let us see what is dollar index chart telling us. Dollar index, which was consolidating between 97.5 to 100 kind of a level from last couple of weeks, it is ready to move higher towards 102.50 to 103 kind of level. If that happens, then euro USD, which is currently trading near 1.1250 kind of level, can move lower towards 1.11 kind of levels, and if that level is broken, then it can again move lower towards 1.10. Now let us understand what are the factors which can affect dollar index to move higher. The first factor which can take dollar index higher is US China trade talks. As we are recording, there is a meeting going on between US diplomats and Chinese diplomats in a city of Geneva. As of now, there are no clear cut indication or no positive news yet came from that side, but market is very optimistic. If any positive news comes, then dollar index can move higher because of the peace talk. The second positive news for dollar is signing of UK and US trade deal. Trump strategically signed off a trade deal with UK, a country with which it already has a trade surplus, which makes UK good more expensive for Americans and American goods cheaper for UK people. And the last factor which will impact both the yields and dollar index to move higher is Fed uncertainty about rate cuts. Fed has last cut its interest rate in the month of December, and in this meeting also they have restricted themselves to cut interest rate. Powell was very vocal, stating that they are not going to cut interest rate till the time they get enough data. Now, for Powell, the concern is rising inflation and inflation expectation. That is a challenge. That is why he is not willing to cut interest rate. In the meanwhile, both Bank of England and ECB cut their interest rate by 25 basis point, and they have signaled that they will continue to do a rate cut because their economy is not growing at a faster pace and their inflation is under control. So now basically US is reluctant to cut interest rate while ECB and Bank of England are willing to cut interest rate. That is a sign which will make dollar stronger and euro and pound weaker in the short term. Now let us discuss the outlook on rupee. Last week we suggested that the rupee should take support near 83.75 kind of level, and ideally it should move towards 84.80 to 85.20 kind of levels, as we were anticipated that dollar index will take support near 899 kind of levels, and RBI might intervene near 84 kind of levels. DXY had taken support near 99 and it moved higher, and in the recent data we were able to understand that RBI's net short position, which was there close to 77 or 80 billion, has reduced drastically to 60 billion dollars, indicating that RBI is on a buying side. But the rupee moved subsequently higher than 85.20, and it made a high of 85.80 kind of levels because of rising tension between India and Pakistan. Now the question is whether it is moving higher towards 86 and a half kind of a level, or whether it is moving back towards 85 kind of levels. Let us understand that. Looking ahead, one thing is very likely that volatility is going to persist, and we are going to see both the side momentum, but we are very confident that rupee will not move beyond 86.50 kind of level in near term because of the following reasons. On the positive side, FIIs have started investing back in Indian equity market. They have invested close to $4.5 billion in last 1 month. Second, we were able to observe that lot of Asian currencies are getting stronger against dollar, like Chinese currency, Taiwan currency, and Singapore dollar. Apart from that, oil is trading below $75 per barrel, which is positive for Indian rupee. On the negative side, if dollar index move towards 102.50 or 103 kind of level, it can put pressure on dollar rupee pair. Second, any escalation between India and Pakistan can also put a pressure on the pair. But we are very confident that we do not expect the pair to move higher towards 86.5 or 87 kind of a level. In fact, what we anticipate is that rupee will be trading in a range between 84.80 on the lower side and 86.10 on the higher side. Now let us discuss strategy for exporters and importers. Any level above 85.50 should be taken as an opportunity by an exporter to increase their hedge ratio. While for importers, we will suggest that they can keep a strict stop loss of 85.90 or 86 kind of a level, and they should wait to cover their imports near 84.70 to 85 kind of level. This we are suggesting for those importers who have missed buying at lower levels, and for how many days they need to buy. They should only focus on covering their near term imports, which means 15 to 30 days. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.